This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Mike back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Mike's picture saying looking for the downloads.
Patrick, as you know, I'm super bullish on uranium miners long term, but we've been in a consolidation for the last few weeks, and I think it may be nearing its end. We've gone from extreme overbought to oversold on both RSI and slow stochastics. The last consolidation in URA ran from July 24th to August 20th, or just under one calendar month. Then we saw a whopping 70% rally over the next 6 weeks. The present consolidation began on October 15th and is now just a hair under 1 month old. In other words, if we use the duration of the prior consolidation as a benchmark, it's about time for the bottom to be put in on URA and the start of the next big rally. But hold on, we're already at historically elevated levels on these stocks, so going outright long URA with new money or even adding to existing positions still carries considerable risk, making an options play seem more appealing to me. What would you recommend, Patrick, to play the possibility that uranium is close to putting in a short-term bottom here? And would you recommend outright shares in URA or call options on URA or an outright long hedged by protective puts or something else?
Eric, your uranium idea is at a technically interesting moment, but expressing it with options comes with some real complexities. As you can see on page 2 of the chart deck, the implied volatility of URA has doubled from roughly 30% to 60% over the last few months. And when vol does that, traditional long gamma expressions like buying calls outright becomes far less attractive. The carry cost goes up, data decay steepens, break-evens move farther away, and you end up paying significantly more premium for the same directional exposure. On the other hand, simply stepping in and buying the stock has its own challenges. URA is volatile enough that any reasonable stop can get clipped by any single ugly daily move. So in this environment, I'd rather structure the trade more intelligently. For me, that means using the in-the-money vertical call spread, which dramatically reduces the vega load while still giving you the directional exposure you want. Using a deep in the money call as a long leg effectively creates a synthetic long forward, high delta, low vega, and minimal extrinsic value. When you pair that with a short out of the money call, the structure behaves like a capital efficient defined risk long position with the upside capped at the top strike. But here's the underappreciated part. You also get the downside convexity relative to holding the stock outright. If URA sells off sharply back towards the at-the-money region, the deep-in-the-money call does not lose value one for one like the Delta 1 stock position. The option sheds delta as it approaches the strike, and the remaining time value cushions the loss. Equity doesn't do that for you. Now, the URA is trading around 47.50. The structure I'm looking at is the January 2026 40 by 60 bull call spread for an $8 debit. And importantly, it's important to observe that roughly $7.50 of that is intrinsic value. So functionally, you should think of it as a capital efficient equity stake rather than a speculative options bet. Now, on the upside, if the trade is working and uranium continues to trend, you will have the flexibility to exercise into the equity and carry the position longer term. So in short, you're getting most of the stock-like upside with defined risk and a non-linear reduction of your losses if we get a fast correction from here.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's get into these equities. What are you thinking of the markets here?
Patrick, we've already seen a brisk rally over the last few sessions on rumors of a government reopening. So this is a perfect setup for the classic sell the news reaction. So a pause or dip here is definitely possible. But that said, I think the major trend is still up and that new all-time highs are likely in coming weeks. I'd like to add a word of caution also about government-supplied data releases. The market has been super eager for resumption of official data releases, and analysts are chomping at the bit, waiting to see what those first official data reports are going to show us as the government reopens. I think those analysts are badly misguided and just asking for trouble, as they usually are. The only sensible way to interpret the current situation is that the government has been shut down for 43 days now. That's the longest political stunt shutdown in U.S. history, and that means everything is a mess. Returning government employees will be picking up the pieces and trying to sort out how to resume data reporting. This is a perfect setup for several weeks of dirty data, as some essential data that normally goes as the input to this or that report ends up being omitted because the source data wasn't available, except they didn't put that in the footnotes because they were scrambling to get back to work. You get the idea. The only sane move here is to fade, ignore, and just not pay attention to all government data for a few weeks. Write it off as probably wrong and ignore it until the system stabilizes a few weeks down the road. But I predict institutional finance will predictably do the exact opposite. They'll react dramatically to new data that they should be ignoring if they had their wits about them, which they seldom do. So my expectation is for several big overreactions in markets to data releases that should have been ignored, frankly, because the data wasn't yet reliable. From a trading perspective, my inclination is to fade those big moves if they happen, regardless of their direction.
Eric, you're spot on with the economic data observations. There's a few things that we want to touch on here technically. We're trading near 52-week highs. The question that is on my mind is, are we seeing a bigger topping formation developing as we continue to see market breadth deteriorating and the overall momentum of the market stalling? Now, we should have a quieter week from volatility from gamma pinning that could occur from the November option expiration. But I think the real momentum shift can come on NVIDIA's earnings next week. The entire AI bubble has been driving almost all this market momentum. And I think that in order for us to see 7,000 to 7,500 on the S&P, it would have to come on newfound momentum on NVIDIA going higher. If we see that the energy is exhausted and NVIDIA fades off of its earnings, that could really stall out the market and start to solidify this bigger topping formation that could see a very challenging period going into December. A lot of this will hinge on that. We'll know by next week's episode, so let's see how this plays out. All right, Eric, what are your thoughts here on the dollar?
Well, the Dixie is still flirting with 100, but it still hasn't broken out, at least not yet. With the government reopening now apparently it's completely signed off, although who knows, it's only a few hours old as we're recording here. Assuming that the government reopening is really happening, I would expect turbulence for a short period before a clear trend emerges. So let's give this another week or two before we decide what's really next and what the next leg is going to bring for the dollar.
Well, the U.S. dollar index remains decisively above the 50-day moving average, now spending well over a month in bull trend. Now, we've had a one-week consolidation, but that's held by almost all Fibonacci zones and still well above its summer trade range. And so at this stage, seeing whether the bulls buy the dip at this 99 level is going to be critical. If they do, we could still see the U.S. dollar dart higher, which would be a huge market disruptor on an intermarket basis, as the reflation trade has been the big trade that's been working all year, backed by this U.S. dollar weakness. So will we get that upside breakout is definitely the thing to watch here. Now, Eric, let's touch on crude.
Once again, WTI is selling off as President Trump reiterated his call for $2 gas prices as his target. It's pretty clear to me that President Trump is beginning to work towards setting the stage for midterm elections, and he's trying to take the most popular things like gas prices and bring them into the spotlight. I agree with many of our guests that the next big move in oil is likely to be up, but I'm not in any rush to buy. February is the seasonality low in the crude oil market, and for now my plan is to wait till then to start building a long position, hopefully with even better location, perhaps down in the low 50s or high 40s before this is over. Meanwhile, backwardation at the front of the WTI curve is almost completely gone, and a phase transition to structural contango appears imminent if the flat price weakness continues. Now, if that structural contango transition is confirmed, it will shake out a lot of longs in the market, further supporting my lower first, then higher outlook for oil prices.
Well, Eric, crude oil remains in its primary downtrend. It failed at its Fibonacci zones and the 50-day moving average. So right now, we certainly have not seen a transition to a bull move. Now, any breakout above $62 could set in a short squeeze on the upside, but that just simply has not begun to materialize at all. But what's an interesting divergence is the fact that energy stocks pretty much right across the board have started to rally. Many of them are well above their 50-day moving averages and have been accumulated in this recent period of crude oil weakness. Not sure what to initially make of that. So it's interesting the fact that traditionally energy stocks that correlate with the movement of oil prices have really started to diverge. I'm curious whether or not that trend can continue here in the weeks to come. All right, Eric, let's talk gold.
Well, I said last week that I saw several technical indications that an upside reversal in gold was likely, and that's pretty clearly been proven out with the $300 rally off the lows. But now the oversold stochastics are back to flirting with overbought again. Now, in the last big rally that we had up to new all-time highs, gold futures extended their overbought stochastic signal into extreme overbought and then sustained that extreme overbought plateau for several weeks. That's what brought us to the $4,400 high. If that happens again, we could be on the way to new all-time highs as I described last week. So maybe the big move is already on. But we're at a make or break point here. The stochastics are back to overbought from oversold last week. So another wave down is equally possible. That could bring a new lower low. So it's still too early to call this decisively, but for now, my bullish thesis appears to be playing out. And even if it proves wrong and we see new lows below 3,900, I'll still be buying that dip. There's no doubt in my mind that the gold bull market is still on. The question is only how long the current consolidation lasts and how deep of a correction we see before the bull market resumes in earnest.
Eric, the gold rally over the last 4 days has been pretty impressive. It's just beat the 4,200 fib zone, which is really demonstrating relative strength on this. The question here is this just going to retest its previous highs in a longer consolidation, or has the next bull phase already begun? I want to highlight that there's a lot of reasons to be structurally bullish gold in the long term. If this correction is over, this would have been the shortest correction of the last 2 years. And typically, they have lasted anywhere from 2 months to even 4 months. This is where I remain longer term bullish, but I still really want to see whether or not resistance comes in here and whether this still develops into a deeper consolidation into December. Overall, the price action is quite positive, and we'll be watching what it does as it trades up towards its previous highs here. All right, Eric, let's touch on uranium.
As I mentioned in the introduction to the trade of the week, the technicals suggest to me that the month-old consolidation in uranium miners is probably coming to its end. And I'm buying this dip in the form of 55-strike calls on URA. Energy Secretary Chris Wright's pledge that he wants to build dozens more nuclear reactors before he leaves office President Trump's pledge to lend $80 billion to Westinghouse to build new reactors. All the news flow is just incredibly positive, incredibly bullish. The big risk here is an unwind of the AI trade because, frankly, most people haven't even figured out the structural deficit in uranium supply. Most, I think, this is entirely my speculative and subjective opinion, but I think most of the strength we've seen since the April lows in uranium miners has been attributable to AI people that are excited about AI. They know that nuclear is needed to support the AI story. Now, ironically, the most likely reason for an unwind of the AI trade would be the realization, and it's a correct realization to be sure, that there won't be sufficient energy to fulfill the present market expectations for AI. So in theory, that ought to be very nuclear bullish. If the problem is there's not enough energy and we need more energy, obviously that has to be bullish. But markets don't work that way. If the AI trade unwinds, then all the people who bought uranium because they were excited about AI are going to unwind those trades as they unwind their other AI trades. And that's going to be bearish, at least in the short term, for uranium.
Well, Eric, I just want to touch here on the charts of the uranium's equities. And like you were observing, they've done this retracement and they are a little bit short-term oversold. And what's particularly interesting to me is that this entire pullback has hit the 61.8 Fibonacci retracement, which is a typical place to see the initial support lines. What I like here is that the 50-day moving average is right there to actually depict the next trend. If we see the URA is able to get back above that $52 area and start building some momentum back on the highs, that will start to confirm that those short-term buy-in dip has materialized and is confirmed, and we'll be looking to see what it does up along previous highs. Now, alternatively, if this is proven to still being early, what you should see is a lot of stalling price action and failed rallies that leads to a sustained period of trading below the 50-day moving average. Now, I'm not necessarily predicting that, but rather just observing that the bulls really need to punch this through that 50-day moving average and build some momentum to really solidify this short-term low.
Patrick, before we wrap up this week's show, let's hit the 10-year Treasury note chart.
Now, finally, Eric, on that 10-year Treasury yield, while we certainly have seen a bounce higher in yields in that post-FOMC meeting, overall, the pattern of lower highs and lower lows is still quite intact. And if we see that any of that economic data that starts getting released here is showing the economy slowing, it may continue to allow yields to remain pivoting along this 4% level and potentially even break below. So we're still watching for that bond strength and yield weakness to persist, but a lot of it will now hinge on the first reactions to some of these economic data and points that are going to start being released.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.